first thing we need to talk about, first thing I need to do is get my talk about the difference between a credit and a deduction, so that we've got that clear in our head. Because up to now we've been talking about deductions. You know, we've had itemized deductions that we talked about. We've had those adjustments for AGI, which are a special type of deduction, but we haven't yet really talked about credits, although you did have experience, I think, in this last chapter with a couple, with the child tax credit and credit for other dependents on your tax return problems. So there was a component, they kind of threw that in. I thought that was really unfair that they did that before we even had covered them. But you've seen that. But up to now, as far as our classroom discussions and the rest of our homework, we haven't really talked about credits yet. So credits and deductions will both ultimately reduce tax liability, but they work a little bit different. So a deduction reduces taxable income. So think about that. Taxable income is calculated at the bottom of page 1 on the 1040, right? That's our box 15 on the 1040. So if they have an effect on taxable income, it means that our deductions are actually going to show up on that page 1 of the 1040, right? Because they reduce our taxable income. If they show up after, then they're not going to reduce our taxable income, because taxable income is on line 15. So all of those deductions, are all listed on page 1 of the 1040. The credits reduce tax. So once we've calculated what the tax is, that's when credits come into play. So these credits are all going to show up and flow through to page 2 of the 1040. Okay, so these are going to be on page 1. These are all going to be on page 2 of the 1040. So let's look at how that works, essentially. So let's just say we have our AGI, let's see what I want to do. Yeah, let's see it. So our AGI is $100,000. So we had some deductions above AGI, right? We had our adjustments for AGI. So we already had some deductions there that or maybe we didn't have any. We didn't qualify for any. So we just have our 100,000. Then we've got our itemized deductions of $30,000, because we want it to be more than what our standard deduction would be, right? So our taxable income is $70,000. Our deductions were calculated before we arrived at this point. Now what we would do is apply our tax rate, right? Let's be simple. Let's say we have like a 20% tax rate. So 20% would be, what is that, 14,000 in tax. And we would stop there as far as our deductions are concerned. So it has reduced, those deductions reduced our taxable income. If we have a credit, that credit is going to come into effect after we've done this whole calculation. after we've figured out what our tax is, because it reduces our tax. So we do this calculation, we've got $14,000 of tax. 14. And we have a credit of, let's say, $2,000. Now our tax is $12,000. That credit reduces dollar for dollar our tax. Deductions only reduce our tax by whatever percentage is applied to them, whatever our tax rate is, right? So this $30,000, if we multiply that by 20%, $6,000 is the tax savings from that $30,000. So it's only a percentage of that $30,000 that we actually get in tax savings. But for a credit, it's dollar for dollar, directly from the taxes. Does that make sense? So this is what we're talking about, all of these things today that actually reduce that tax. But in essence, this is the difference. Reduces taxable income versus it reduces the tax. So if you have a, let's just say, we won't use the income amounts here. Let's say we have a deduction of $1,000 and we have a credit of $1,000. And our tax rate is 22%. Our tax savings on that $1,000 deduction is going to be 22% of that $1,000, so $220 tax savings. Over here, if we've got a $1,000 credit, our tax savings from that credit are $1,000. So oftentimes, most times, tax credits are going to be more valuable than tax deductions. Not always. You still have to qualify for each of them, right? And we'll go through some of the rules for qualifying for each specific credit. Questions about the difference between a deduction and a credit? No? Okay. One other thing that I want to talk about before we start getting into the nitty-gritty is we have two different types of credits. We have what are called refundable credits and we have non-refundable. This only pertains to credits. We don't have deductions that are refundable or non-refundable. What this means is that for I'm going to say the non-refundable one first. Non-refundable credits cannot reduce tax liability below 0. Okay, cannot, and now I'm not saying the refund. You can still get a refund even if you have a non-refundable tax credit, but it can't reduce the tax liability below 0.
So what you're saying is it can only reduce up to what they would have.
Yes.
That's the money.
And I'll give you an example. Refundable credits can reduce tax liability below 0. This means that even if you don't have any tax liability, if you are entitled to a refundable credit, you get money back. That's the stimulus checks that they sent out were essentially refundable tax credits that everybody who qualified for them qualified for, but they were given ahead of time. there were individuals that didn't actually receive those checks, and then what they did was they applied them to their tax return, and that's when they received the money. But it was a refundable credit. So you got the money even if you didn't owe the tax. All right, so let's take a look at what that looks like. So let's just say we've got tax liability of $3,000. And we have a credit of $4,000. In this case, we're going to get this back. Now remember, this has nothing to do with how much we've already paid in. We don't know if there's a refund or tax due or what have you, but you're comparing the tax liability to the amount of the credit. In this case, a larger credit, you're still going to get a benefit. For a non-refundable, you lose out on that extra $1,000. You cannot apply, you don't get the full credit because your tax liability wasn't high enough for it. So it absorbs all of the tax liability, but not more than that. Whereas with a refundable credit, it can absorb more than the tax liability that you have. So essentially you're getting money back that you didn't even owe. Free money. Okay. The list of credits that we're going to talk about include both refundable and non-refundable credits. Questions about that? Okay. Let's get into it. We're going to start talking about the dependent care credit.